I've always wondered to myself, is there something that helps the entrepreneurs that succeed that they have, which other entrepreneurs don't? Is it something they know? Is it how they run their businesses? Is it the people they hire? Is it where they went to school? Is it their socialization, their background, their education, their mental spaces? What is it that makes the entrepreneur succeed? Welcome to my masterclasses, where I share with you everything you need to know about how to become a high-growth, high-scale entrepreneur. I'm joined by guests. We break down the myths, the ideas, the lids, the legends, everything you need to know to become a high-growth entrepreneur. Warning, this is the High Performance Zone. What's more important in a business, a balance sheet or cash flow? Why? Hey? Say again? Yeah, to really build your balance sheet. So in a balance sheet, what's actually more important is the cash flow, not the assets. Like you can have an asset-heavy business with zero cash flows, you'll die. You'll run into a liquidity problem very quickly. We didn't break down the balance sheet. Okay, so let's break down the balance sheet. So it's assets. Current assets. Where's my assets, left or right?
Left.
No, but you're on top.
Yeah, but where? Okay, so balance sheet is assets must equal OE plus L. Okay, I break the balance sheet up very simply. I don't get into like all say again?
I can't see equation.
Yeah, I don't get into like all the technical, there are different classes of these. I just classify them. Then I know what item on my income statement goes to which item. That's how I remember it. Because remember, I'm an entrepreneur, I'm a business person, I'm not an accountant. Yeah? So, okay, so there are two types of assets. What are they?
Non-current assets and current assets.
Yeah, well, non-current liabilities. It's a fixed asset. Yeah? And
Financial assets.
It's current asset.
And a current asset.
Current assets.
Do you agree? Yeah. And both of these together give me total assets. And up here would be my, don't say, current liabilities, short-term debt, and shareholders' equity. Yes. Am I right? I'm not missing anything. No. Oh, long-term, sorry. Long-term liabilities. Cool. This is how I classify. Every single item on my income statement, guys, I can put somewhere here. Okay? How do you build wealth in a business? What does an investor buy when they buy into a business? Say again? Sorry? Equity? Well, they'll buy, yeah, it'll be expressed in equity, but what do they value the business on? Assets, right? And particularly what type of assets? Net assets. So in other words, what I want to do when I build my business is I want to get this guy bigger than this guy. I want my assets to be more than my liabilities, because the difference between these two is the equity that I own or the wealth I create. Make sense? If it doesn't make sense, scream. Happy to explain it. When you start a business, you put R1 into the business. It's called owner's contribution. It's part of your shareholders' equity. It's what you as a shareholder own in the business as equity. At the end of the year, if I put R1 in and the business generates R1 10 cents, my business has grown by 10%, which means I've created 10% worth of value. Does that make sense? Yes. Very, very simple. So let's go back to, I want to find it, our income statement. Watch. Revenue, cost of goods sold, gross profit. Then I get to my gross profit line. I pay up all these expenses, right? Remember when I went to the bank, because I'm Sam, and I went to the bank and I got a car on debt? Remember that? Yeah? So I would have bought that car on debt. What car do you like, Sam? Oh, Jason Kulul. We just had the conversation. Sam, you're getting a Hyundai Grand i10. That's what you're doing. So Sam's going to buy a Hyundai Grand i10. And she's going to brand it beautifully. And she's going to take the Hyundai Grand i10 and she's going to have it as part of her assets. Would we agree? But she has to pay it back. So the portion you pay back that year is going to be part of your current liabilities. Yeah? The portion you pay back year 2, 3, 4, and 5 is going to go into your short-term debt. Make sense? Until you pay it back. The point I want to make, very simple, is when it comes here to your balance sheet, as the owner, you want to focus on one critical number. It's this thing. All the balance sheet is going to tell you is, are you getting wealthier or are you getting poorer? That's it. And you just got to be very clear about how your actions are forcing the business to get wealthier or poorer. So, ma'am, this links to the question about cash, which is why I wanted to jump to it. You want to buy the building, right? So immediately what will happen is if you buy the building, your fixed assets are going to shoot through the roof. But you have to raise money to buy that building. Yeah? Which means your debt is going to shoot through the roof for you to buy this building. Make sense? Whereas, if I went and found a building that I could manage, my assets are kind of going to stay the same. I don't have to raise any money, yes, like this fellow, which means my liabilities would stay the same, but I'm immediately going to start generating revenues. Thanks, Gita. I'm immediately going to start generating revenues, yeah? And from generating revenues, I'm going to make profits, which means my shareholders' equity is going to grow without me taking on debt and without me worrying about fixed assets. There is a different time in a business when you have to worry about fixed assets, but it's a different time. There are some businesses where you need fixed assets, where you need plant, you need equipment, you need that type of thing. It's a competitive lever. But upfront, when you're starting your business, you don't have to worry. You shouldn't worry about assets. What you want to worry about is cash flow, cash flow, cash flow, cash flow, cash flow, cash flow. Cash flow pays for petrol, pays for medical aid, pays the bills, sends the kids to school. You can go clubbing once in a while. Cash flow. Yeah? Cool. Few more questions.
So my question is, I have a bakery.
Yeah.
Slice Bakery.
Lice.
The Slice Bakery.
Slice.
Yes, it's based in Tata, so it's streetwear. So one of the things we did, we started buying the big branch bread, and we started selling that. And then a year later, we started making our own bread and delivering that. So it was part of a strategy of the one we're talking about, how the big guys mustn't see you coming. So in that time, we're building up momentum to get to know the competitor and the customers. So we've done well. So now my question then is, having done well, due to capital being an issue and cash flow being an issue, I brought in people in the business.
Partners.
Partners.
Did they put money in?
They put money in. So now it was an issue of equity now.
Yeah.
That I still want to maintain
control.
majority shareholding.
Sure.
Of which, based on the logic I created, I still do. But now, I want to make it official and legal.
Yeah.
I don't know how to do that.
That's
so
fair.
I need guidance on that, because now the business broke even for the first time last month.
My man, well done.
After 2 years. Because I can see that the millions I forecasted are coming soon, I now need to tie up the loose ends, because I do not want that relationship later on, or people feeling like I robbed them, or me feeling like I've been robbed. So I need guidance on how to define shares.
Can I double click?
Yes, please.
So first, let me just say, one, congratulations on finally going and breaking even. Second, good on you for having the fortitude to know, because
Yeah.
there are some relationships where you are happier when you're poor than you are when you're rich. And I think you're right. The third is, so how did you structure it? How much money did they give you?
All right, it's approximately 6 of them combined. You're looking at less than 200,000.
Okay, and what was the terms of the money? Was it equity or debt?
It was equity.
Equity.
There were some who were debt that was taken care of.
You paid them out?
Not all of them, but I mean, I'm paying them out currently.
Okay. Do you mind if we use your case study?
Yes,
okay?
yes, please.
Come on here.
All right, thank you.
When you put money, when you start a business, yeah, it's either the owner putting the money in, or you're raising debt from someone to put the money in. Make sense? There's only 2 ways money gets raised: equity or debt. So anytime you're talking to someone about raising funding, What you want to know is it equity or is it debt? Grant funding is not really funding as much as it is a donation. So you can't call it funding. But in this country, because we have GFIs, anyway, it's called grant funding. The point is, anytime you're raising money, there's two terms, equity or debt. There are different types of debt and different types of equity instruments. Some are more senior than others. People who specialize in debt will talk about mezzanine, which means that there are different classes of debt that realize at a different time. Very fancy way of saying equity or debt. Okay, so you got 200K, yeah? And they gave it to you as equity. The debt portion you paid out.
Not all of it, but
You're in the process of paying it out?
Yes.
You pay out the debt using the cash flow in the business?
yes.
And are there
But
terms?
some of it is from my personal pocket.
Right. And are there terms of the debt?
No,
So how do you know how much to pay?
I'm paying what you gave me. But it was not a defined term. You gave me 2,000, I said give you back 2,000.
I understand. This is important. Did they give you a lump sum and you're paying them back a lump sum in parts? Or did they give you small parts and as they gave it to you, you were paying it back?
Lump sum.
And you're paying it back in
smaller
parts.
yes.
That lump sum, did it have an interest charge on it? Was it like, here's money when you have money paid?
Yes, it was like that.
Here's money here when you have money paid.
Yes, when you have-
All right, cool. So what we call that is debt and goodwill. What it means is if you didn't pay it, no one could take you to court.
Yes.
But if you don't pay it and they see you do well, someone's going to be angry. Yeah? Cool. So if you're a person of integrity, you want to pay it.
Yeah.
If you're a person of no integrity, let them be angry.
Yeah.
Right. So this 200,000 Rand is equity. Can we double click?
Yeah.
What did your business make last year?
It did not make anything. You see?
Yeah. What turnover? For the whole year. I want to know top line for the whole year.
Approximately 80 to 800,000. Yeah.
For the year.
Yeah.
800K.
No, 80,000 to 100,000.
80 to 100.
Yes.
Is it 80 or is it 100? Let's park it at 80.
80.
Right. And you said profit you made nothing.
Nothing.
Do you work?
Yes, I will.
All right. So you're getting a salary from somewhere else?
Yes.
Right. So what he's doing is actually very interesting. Is if you're making a revenue of 80,000 and you're making profits of nothing,
Yes.
what does that tell you about who's funding your business? He is.
Yes.
Exactly.
Yes.
So what he's doing is he's taking his salary and he's putting it into his business to keep it afloat.
Yes.
Yeah? It's important, it's fun to do it, but it's important in your head to know your business is not yet self-sustaining.
Yes.
Like it's really important to do this.
Yeah.
Okay? So, at 80,000 Rand top line, that means you are at a profit before tax of 0.
Yeah.
Am I right?
Yes.
What's the value of your business?
I'm trying to define that.
Yeah,
but
I know.
Based on my knowledge now,
What do you think your value is?
I think it's approximately 400,000.
Why?
Because of the money that has been invested and the assets it has.
What are the assets?
I've got bakery machines, I've got a delivery vehicle.
My man, I like that. Okay, so let's jump to balance sheet. So your assets, you've got machinery. How did you buy the machinery?
From my pocket and from the shareholders I told you about.
Right, so people gave you money, you raised it at equity, you went and bought assets with it,
Yes.
and the assets are there.
Yes.
These are machinery,
Machinery.
right, which means your rate of depreciation, you know this is very high, right?
Yes, it is.
What you depreciate for in book is not what you get in market. So if you went and did a mark-to-market analysis, you're going to find that your balance sheet is overstated. But let's park that. Your assets, how much did you spend?
Approximately 95,000.
95K.
Yes, but the delivery vehicle I'm paid in installments, so I didn't buy it cash.
Yeah, so I'm not going to count delivery vehicle.
Okay.
I want to know the machinery. So, so remember that when you do a valuation, there's a couple of ways to do it. But for a business that is not profitable, then the way we value it, what VCs would do is they do something called a fire sale valuation. It's a liquidation valuation. In other words, if today you stop trading,
Yes.
what could I take and sell and for how much?
Okay.
That's what that business is worth. If there's nothing to take and sell, it's worth $1. If there is something to take and sell, that's what it's worth.
Okay.
He, as an entrepreneur, won't agree. You know why he won't agree? Because he knows that built into this revenue number is a little thing called goodwill. Customers every day who buy from him, which is why he says it's worth 400.
Yes.
I'm gonna say it's worth 20. Because this machinery you have sitting in your assets, the people that make that machinery, do they make other machinery?
Yes. Yes.
And they sell to other bakeries?
Yes, they do.
Right. And do those other bakeries buy that machinery?
Yes, they do.
Yeah, so why would I then take your machinery, which is used, and go sell it to another bakery? In other words, the market for what you believe is an asset is tiny. So what you might have the asset for in your books is never what you're going to sell it for in the real world. This is a proper wake-up call about what's your business actually worth. Okay, so his number, 400. Remember? Mine, 20. And I think I'm being generous.
20,000.
20K. I'd pay him 20K, if that.
Does he have contracts? Fixed
We'll
contracts?
come there in a minute. So I'd pay him 20K, if that. And even then, I might pay him 20K. I would only pay him 20K, actually, if I had a bakery that really wanted the machinery. If I didn't, then I wouldn't. Do you know what I'd do? I'd leave him. Let him die. Then when he dies, I'll go on auction, and the hammerman will sell it for 15. Remember, I want to buy the asset. I want it for the cheapest price. It's a machinery. Yeah? The other risk you have is when you buy, those of you who buy businesses with machinery, remember this. The minute you invest in a piece of equipment, the manufacturer of that equipment is always making the equipment better. So the one you bought yesterday is old. It's like buying a cell phone. Next year there's a new model. So you can't sell the cell phone that you bought for 15,000 Rand for 13,000 Rand. You and I both know in the market it's maybe worth 4, 5 if you're a good salesman. Okay. Right. Now let's get to your conversation about, so I want to do a valuation.
Okay.
So these guys put in 200,000 as equity.
Yes.
Your customers that buy from you, do they buy on contract or do they buy on goodwill?
There are those who, like your corporate, your hotels, that buy on contract.
So you have signed contracts,
Yes.
guaranteed income.
Guaranteed income, but it does not pay all the bills. So we're still building up in that corporate sector.
And then you have the ones that don't buy on
Yes.
contract.
Your communities, yes.
Okay.
Your spaza shops.
What portion of equity did you give them?
The toilet. So what I did is I looked at how much I had spent at that time, and I then said 200 divided by everything I had spent and the guys I had trained. And I said, if you gave me 50,000, so 50,000 divided by 300,000 I had spent, that's the percentage I am giving you tentatively until I meet with Vusi to guide me on how So that was an email sort of agreement so that we are clear how we move forward, pending a legal advisor and accountant to guide us on how to do this.
Yeah, don't get an accountant to do the valuation. An accountant is going to account. There's nothing to account here.
Okay.
So I'm going to give you some advice. Okay, here's what I would do. I would take the 200,000. You want to maintain management control?
Yes.
You want to run your business, right?
Yes.
So I would take the 200,000. I say to them, guys, I'm going to take the 200,000 and I'm going to split it up into debt and equity. I'm going to give you 100,000 Rand as equity, 100,000 Rand as debt. You can't take all 200,000 Rand as equity because if you do, you're going to overstate your shareholders' contribution, which is going to push down your holding as the initial investor. And if I did a script, basically if I said issue new shares for this 200,000, you're going to end up with nothing because you're going to get diluted out. Okay? So here's what I would do. I'd take this 100 and I'd split it into debt and equity. Say 100 here, 100 here. Then I'd take this 100 that is debt and I'd make it something we call lazy debt. I'd give it a vesting period. So I'd say, guys, look, you have 100,000 Rand you've invested in my business as debt. The reason people want to invest debt, let's go back to the income statement. Who is it? The reason I prefer debt investments in a business than equity investments is because when your business goes under, I, as a debt holder, have protection. If I'm a shareholder, I don't. I have to wait for dividends. But if I hold debt in your business, then one of the people that the liquidator must recognize is the people to whom you owe money. So when they go through a liquidation, I'll tell you guys an interesting story about how I just lost 250,000 Rand in a liquidation. Long story, burns my eyes. I actually just realized I lost a lot of money last year. Anyway, so if you go through a process of liquidation, the liquidator says, how much do we owe the authorities? Typically SARS is one of them. And if you're a licensed company, it's whoever else. Then they go, how much do we owe debt holders? Yeah? Then they go, how much do we owe suppliers? Then they go, how much do we owe employees? Then they go, how much do we owe shareholders? So if I hold equity, I put all the money in, but I take the highest amount of risk. Whereas if I hold debt, I put money in, and even though I take risk, it's a little less. Okay, so I would split it. Then I'd say, this 100,000, we're going to pay 12 months. Yeah? Pari passu, 12 months after the date of issuance. And you make the date of issuance the day you send the contract. So we send a debt contract. You give me 100,000 rand today. From 12 months from today, I'm going to start paying this 100,000. And I'm going to pay it at a yield. And you give them a decent yield of inflation, 6%. So you're going to go 100,000 times 6% divided by number of months. That's your installment every month. Then every month, the way you pay your car, you pay them that amount of money. That is going to help them go, okay, cool. I can see a plan to get my 100,000 out. Then the 100,000 that is equity, you then go and say, but we need to value this business. So I can get a valuation of what I think this business is worth. I can't use a liquidation process because my assets are worth less than you've invested. Do you agree? I can't use a cash flow model because I can't predict my cash flows because most of my customers are goodwill. I can forecast, but it's a cash flow. So most people actually in this room would probably run a DCF. I wouldn't. You know what I would do? I wouldn't run a DCF. I wouldn't run a net asset value. I would say, I'm going to take this 100,000 guys and I'm going to give you generously, listen to this, 51%. And then he takes a deep breath. Hold on. He takes a deep breath because he realizes at 51%, he doesn't own his business anymore. Then what you do is you do that thing Mark Zuckerberg did to tech, which pissed everybody off, and then they figured out he was a genius. You issue something called an NPREF share. It's not part of the Companies Act. I know it sounds like I'm speaking gibberish. After this, I'll show you how to do it. The NPREF share gives you, even though you are only 49% shareholder, at an equity level, it gives you full management control. This is how you end up with, what's his name? Koos Becker from Naspers. He owns like 6% of Naspers, but you can't tell him shit. Koos goes and sits, and then he decides what is the dividends policy, what is the remuneration policy. You can go and argue, and Theo Botha does. The shareholder activist goes to every single AGM and argues, and Koos says, excuse me, I happen to own the N shares, and my N shares give me preference. I've got one tech investment right now where we have exactly the situation. There's nothing you can do. It just gives them superior power. And one of these N shares usually has something like 1,000 the power of an ordinary share. Now, in a company, think about it. Let's say your company has issued 1,000 shares. Yeah? And you're saying to them that they own 51% of 1,000 shares, which is 510 shares. If you own N shares, yeah, that are worth more than this, you'll always have more power than them. Then you just issue the N share script and you keep quiet. Finish and Clara, they sign the shareholder document. But it depends on how you want to do it. Most people who do this don't disclose what they're doing. They just make you sign a thick document like this. Me, I would disclose it and help them know. It's because as the entrepreneur, I know what needs to be done in this business. I want to maintain management control. Where at the end of the year, when I declare dividends, I will pay you 51% of the profit. You'll always earn more profit. I just don't want you phoning me on Tuesday and telling me what to do. You got to separate the shareholder responsibility from the management responsibility. Those are not the same things.
So end of the year, they will earn more than me.
That's only her. That's only her. Only her. Wait. What? Only her. Wait. This is important. End of the year, you would have earned a salary, yeah, and you would be earning dividends. They are just earning dividends. That's one. Number two, even if they earned more than you, they took the risk. You see, and you can't equate their risk to yours. I'll tell you why. Even if you put in 500,000, it's your business. It's not theirs. So they've taken 200,000 rand of their money and given it to you for your business and have trusted you with it. Yeah? So they deserve in kind something that pays them for it. Then what you do is you do a drawdown. Who knows what a drawdown is? Okay, so do a drawdown. So then what you do is this. 100,000 of the money you've invested. Let's say 51% might not be the number. Maybe make it a bit less. Maybe I'm being generous. Maybe, right? And you say, every year when I pay you dividends, until you realize this full 100,000, I'm going to draw down your actual shareholding.
Okay.
In other words, you took a risk of 100,000 today. When I put you back to the original position you were in of having your 100,000, you can keep your shareholding, but it can't be 51% anymore.
Okay.
Now I'm happy for you to keep your shareholding and you reduce this to 15%. That way, guys, there's an incentive for me to pay you back your money so I can have you owning less of my business.
Yeah.
And there's an incentive for you because you're going to earn your money back, plus the dividends I declare, plus the interest I pay you, plus the initial debt portion.
Yeah.
Guys, it's a good deal. Because all you want to do is just bake bread. I mean, you want to bake bread. Not that one. These guys. Are we learning? Does this make sense?
Yeah.
Questions?
And then now, who can draw that for me? When I go to them, because now I just want to make things legal on paper.
He's going to say something in a minute, but you know the hard part is, so there are a couple of systems you can go to online.
Okay.
You'd buy a subscription and you'd input the information up front, and it'll draw the legal contract for you. But those are general legal contracts. For this, you're going to need a person who understands corporate law. We've sometimes paid, what was the most expensive shareholders contract I did? It was probably about $500,000. Yeah, for a contract. My lawyers charged me 28,000 Rand to send you a letter. Yeah, true.
Very expensive.
But they're the #1 law firm in the continent. So you know why I have them? Because when people get a letter from them, they act. It's like, who's this lawyer? Just pay him. Just pay him. Just pay him. It has the scare factor, right? Let me see after this how I can help you. Maybe I can connect you with one of these like corporate law firms coming up that could do it for a fraction of the cost. You will have to pay for it. This, in my mind, is probably the single most important investment you'll make in your business. Okay. Protect the shareholding of your business. Do it now. Yeah. You've got to have the shareholding and the documentation from a contract perspective in your business now for the business you're building, not the one you're in.
Yeah.
Make sense?
Yeah. Thank
cool.
you.
What I wanted to say is there's lots of ways to skin a cat. So for example, he can always convert his loan. So all the amounts of money you put into training
100%.
and make that into shares.
He's right. He's 100% right. So what he's actually saying is dead right. So all the amount of money you put, so it's called there's a word for it, pre-event something, but there's a term for it. Basically, if you raise the money today, day 0, all the money you put in before today, you can recognize that money up front in the business and say, I've put this money in as debt.
Yeah.
And then say, but now when I get here, I want to convert that money from debt to shareholding. So even though you're putting in money, the money I put in is actually more than you.
Sorry.
And then you would have a lower shareholding. Very good. Go talk to the commercial and say. Yes.
Never mind. I wanted to ask you the pre-adjusting event.
It's a pre-adjusting event. That's the word. It's exactly the. See, it's masterclass. We're masterclassing here. Here, yeah, we've got an accountant, a lawyer. Any engineers? Look at us. We're building a nation here, guys. Eh?